Students, now we learn the third problem in relation to normal dissolution of partnership firm. In this problem, we are going to learn the treatment of external liability taken out by the partners. Yes, look at the problem. The following was the balance sheet of A and B as on 31st December 1983. Liability, assets. Creditor, Mrs. A's loan, B's loan. So there are three external liability. Reserve fund should be transferred to the partner capital account. Then we have A capital, B capital. Credit side bank account, stock, debtor, minus provision, fixtures, plant and machinery, investment, profit and loss account. The firm was dissolved on 31st December 1983 and the following was the result. A took over the investment at an agreed value of 8,000 and agreed to pay off the Mrs. A's loan. So A took over the investment under Mrs. A's loan. He took over one asset and he took over one liability. Yes. Then the assets realized as follows: stock 5,000, debtor 18,500, fixtures 4,500, plant and machinery 25,000. The expenses were rupees 1,100. The creditor were paid off less 2.5% discount. A and B shared profit and losses in the ratio of 3:2. Prepare necessary ledger account. As we know, we have to prepare three important ledger, namely realization account, capital account and bank account. First, we have to record journal for all the assets. All the assets should be transferred to the realization account at book value. Book value means balance sheet value except bank and profit and loss account. Yes, leave the bank, then stock. To stock. Stock book value 6,000. Next, debtor book value 20,000. Provision for doubtful debts. Provision for doubtful debts treated as a liability. Doubtful debts should be treated as a liability. For this, we need not to make payment. Then we have fixtures. Fixtures book value, balance sheet value 4,000. Then we have plant and machinery. Plant and machinery, its value, book value 28,000. Then investment book value 10,000. Profit and loss account should be transferred to the partner's capital account. Here, out of these assets, the investment took over by Mr. A. For that entry is A's capital account data to realization. So it will be recorded in the credit side as A's capital. He took over the investment at 8,000 rupees. The remaining assets were realized as follows. For that entry, bank account data to realization. The stock realized at 5,000. Debtor realized at 18,500. Fixtures 4,500. Plant and machinery 25,000. The all assets were realized for 53,000. So we completed the treatment of assets. Then we'll move to the external liability. There are three external liability: creditor, Mrs. A's loan and B's loan. First, we should settle the B's loan. B is a partner. Partner lend loan to the firm rupees 15,000. For that, we should make payment directly. The entry is B's loan account data to bank. So it will be recorded in the bank account credit side as by B loan 15,000. Then Mrs. A's loan taken out by Mr. A. For that entry is Mrs. A's loan account data to Mr. A's capital. So it will be recorded on the credit side of capital account as Mrs. A's loan posted to the A's capital account value 10,000. So balance we have creditor. Creditor should be transferred to the realization account. The entry is creditor's account data to realization. Then we should make payment to the creditor. For that entry is realization account data to bank. So total payable to creditor 38,000, of which 2.5% discount is available. 38,000 minus 2.5%, balance we have 37,050. At last we have one adjustment, realization expenses, its value 1,100. So to bank, realization account data to bank value 1,100. We'll close the realization account now. The debit side value heavier than credit side. So 6,000 plus 20,000 plus 4,000 plus 28,000 plus 10,000 plus 37,050 plus 1,100. So total debit side value 1,06,150. 1,06,150. Deduct all credit side value minus 1,000. Minus 8,000, minus 53,000, minus 38,000. So the balance available is 6,150. This realization loss. Realization loss balancing figure. It should be transferred to A and B capital account. It should be transferred to A capital and B capital in 3:2. So 6,150 divided by 5 multiplied by 3. So 3,690 payable to A, balance 2,460 to B's capital. Yes. So 6,150 should be divided in the ratio of 3:2. For A's capital 3,690, for B's capital 2,460. For this entry, A capital account data, B capital account data to realization account. Then we have to prepare capital account. For that we will take the existing capital. It will be recorded in the credit side of capital account as by balance BD. By balance BD. Its value 10,000, 8,000. Then we have reserve fund. By reserve fund. Value 5. Reserve fund value 5,000. It should be divided in the ratio of 3:2. So 3,000 to A, 2,000 to B. Then profit and loss account recorded in the asset side. So it will be recorded in the debit side of capital account. For this entry, A capital, B capital to profit and loss account value 7,500. It should be divided in the ratio of 3:2. So 4,500 to A, 3,000 to B. Then we will take the capital from the relation account. Debit side we do not have any capital. Credit side we have capital. The assets taken out by Mr. A. It will be recorded in the debit side as to realization. 8,000 recorded in A's capital. Likewise, we have realization loss. For this entry, A capital, B capital to realization. So it will be recorded in the debit side to realization. To realization, 3,690 to A, 2,460 to B. Now we'll balance the capital account. As far as A is concerned, debit side value 4,500, 8,000 plus 3,690. So debit side value we have 16,190. 16,190 minus 16. Credit side value is heavier than debit side. So credit side value 23,000. Credit side value 23,000 minus 16,190. So balance surplus available to Mr. A rupees 6,810. That should be transferred to bank. So for this entry, A's capital account data to bank. Then we have B's credit side total is heavier than debit side. So 10,000 minus 3,000 minus 2,460. So the balance excess payment to B 4,540. Now we'll prepare the bank account. For that we'll take opening balance of bank. It will be recorded in the debit side as to balance BD. Its value 11,500. Then we'll take bank account from relation and capital account. Debit side we have two banks. One bank for the payment of credit. The second bank is for expenses, relation expenses. It will be recorded in the credit side as by realization. 37,050. Another one is for relation expenses. By relation its value 1,100. Likewise, in relation account credit side we have bank, that is for assets relation. It will be recorded in the debit side as realization 53,000. Then move to the capital account. Credit side we do not have any bank. In debit side we have bank. It is a payment to A and B capital. So for that entry, A capital, B capital to bank. So it will be recorded in the credit side by A capital by B capital. Values 6,810. For B 4,540. Now we total this. It should agree. Yes. 11,500 plus 11,500 plus 53,000. So the total debit side value 64,500. Credit side 15,000 plus 3750 plus 1,100 plus 6,810 plus 4,540. So credit side also we got 64,500. Students, we completed the last problem in relation to normal dissolution of partnership firm. In next class we will solve different problem. Till then, bye and thank you.